You'll have to, you'll have to ask your near neighbours, won't you, for permission to kill the
swans. What, the Queen?
They're protected. They're protected.
It's the Mercer's company you've got to worry about. They're the bastards.
I'm just about to say we're being recorded now, Henry. So keep it clean.
Sorry,
but we've missed that. But there you go.
That's the Mercer's livery company, not Mercer's.
Yes, I know. Right, I'm gonna. Any questions before we start, Steve? All good?
Yeah, good from us.
Yep, fine.
Yeah,
all right, I'll admit all, and we'll crack on. So. Good morning, Charles. Morning, Chris. Morning, Bryn. Morning, Derek.
Morning.
Morning, JQ. Happy New Year, everybody. Thanks for joining. Really good to see you. If you could all mute, if possible, to cut out some background noise, that would be including myself. Michael, I'm going to mute Michael. If you could, Mike. That's it. Thank you, Michael. That's great. Thanks for joining. And yeah, Chris, if you could mute as well. Chris Giles, if you could mute, that'd be good. JQ, why are you waving your arms in the air? Is this your? We were just hearing a story from Henry that the Thames is just about to enter his building in Eton. So if he runs off with his sandbags, then we'll know there's a problem with his front door. But hopefully it won't get to that, Henry, will it?
No. It's it's really first world problems.
Indeed.
So I don't expect any sympathy from anyone.
Oh, okay. And you probably won't get any either, to be fair. But there we go. So there we go. Right. Listen, it's 10:32. Good morning, everybody. Welcome to the first coffee morning of 2024. Happy New Year to you all. Hope you had great Christmases and great New Year celebrations. We're delighted today to be joined by Steve Barker, who's Managing Director of Barker Tatham. And he's going to be talking about the LDI after the gilts crisis. And the presentation is up and running. We are being recorded, so can we have a thumbs up if everybody's happy to be recorded? Thank you very much indeed. And as usual with Pension Playpen, we are very keen to hear your views and your thoughts. So if you'd like to raise a hand and ask a question, please do. No doubt Henry and I will be asking some questions later on in the presentation. And obviously we'll open up the chat as well. So if you want to put any links or any ideas or any comments in the chat, please do that also. And without any further ado, Steve, I think you were presenting the slides. So if you want to share your slides, you can start your presentation. I'll pass over to you and away we go. All good, Steve? Or is Steve frozen?
Yeah.
No, you're there. Good. Yeah.
Can you see the slides?
I can't see the slides. Can everybody see the slides? No, we can't see the slides, Steve. So
okay.
Just try sharing them again. Looks like you may be slightly frozen as well on my screen.
Okay.
Andres, is he frozen on your screen?
Yes, he is.
Yeah.
It's not the worst.
Steve,
not the worst face, but he's frozen.
Okay. Is that still not displaying?
No.
No, can't see anything.
I had it working a while ago.
Morning, Bob. Let's just.
It was there when we all signed in.
Yeah, and then suddenly it disappeared. So is it your end, Steve? Maybe.
Okay.
Or...
Here we go.
Oh, here we go. Looks positive.
Has it come up?
Something's coming up. Have you still got a? Have you? Are you on?
Yeah,
there we go.
there we go.
Yay! We can see it. We're there. Yeah, you are freezing a bit though, Steve. So I'm a bit worried about your broadband.
Okay.
You might need to upgrade. Spend some money on upgrading. So
Well,
anyway, I know.
Right.
I'm joking.
Okay.
All right. Over to you.
Can you hear everyone? Sorry. Whoops. Okay. Right. So it's not very often that the pensions hits the news. And it's never going to be a good news item. I've never expected to hear Fred Bloggs retired successfully and got everything he was expecting. But in late September 2022, not only did it hit the news, but it was the first item on the BBC News at 10. For me, I thought it was really poorly reported what happened with the gilts/LDI crisis. We had something along the lines that gilt market had crashed, LDIs were destroying pension schemes, putting pension scheme benefits at risk. The Bank of England's had to ride in on its trusty steed to save the day and rescue these pension schemes. Now, for me, it's a little bit like Les Dawson's piano playing, that they've got all the right words, but not necessarily in the right order. For me, it was a bit of a misrepresentation of what went on. And it was even more disappointing when I think some of the pensions press also didn't actually get what was going on particularly well. It was a major market movement of that. There's no doubt. And I want to use the word unprecedented, but I'm a bit hesitant for two reasons. One is that unprecedented gets used far too often. If you watch any news on the in the evening, you'll hear unprecedented several times over the course of the 30-minute slot. But not only that, in this case, it's actually not accurate. We have seen a movement in the gilt market of this scale before. The only thing is that when it last happened, France still had a king. So did the Americas. It was King George III of Great Britain. But just because there was a big movement and a crash in the market didn't mean to say that everyone lost out. And the thing that I take issue with is that pension schemes universally were put at risk, and that wasn't the case. Losers from what's happened to the gilts market, and I thought it would be just worthwhile just having a look at who were the winners, who were the losers in terms of DB pension schemes from that time. Is this, are the slides moving on?
Yeah, now winners and losers from crisis.
Brilliant, yeah. Brilliant. So schemes that had used LDI to perfectly hedge their liabilities. Now, if you were able to perfectly maintain that hedge throughout the whole period, and I say that if, that's a big if. In theory, it's possible. In practice, no scheme exactly hit this. But if you were perfectly hedged throughout that whole period, you could have been completely indifferent in terms of this crisis. That your liabilities would have fallen to the same extent as your assets. Your net position would have been unchanged. So the ones that got it bang on should have been indifferent. There are some schemes that didn't have any hedging in place at all because they'd chosen not to, or for whatever reason, and they made out like bandits. Their liabilities would have fallen in value dramatically, and there'd have been no hit to their assets. Their net funding position improved. Schemes found themselves going from a deficit on an ongoing basis, in some cases to being having a surplus even on a buyout basis, just through taking a big bet and that bet coming in spades. Some schemes were partially hedged. So if you were 50%, 70% hedged, you'd have seen a big improvement in your funding position. Obviously not as big as if you didn't have any hedging in place at all. More realistically, schemes that aimed to have 100% hedging wouldn't have been perfectly hedged throughout the period. So to the extent that they were inaccurate, depending on which side of the thing you were at which time, if you were lucky, you might have made a bit of money. If you were unlucky, you might have lost a bit of money. And there'll be a large number of schemes that probably fall under that category. But the more important losers are the next few that I want to look at. So there were some schemes. There was one that we managed where they had the wrong investment objectives in place. Now, by that, what I mean is what they thought they were trying to achieve turned out to be not quite what they were trying to do. They thought they wanted to protect their deficit from increasing in absolute terms, when in fact, so that if for example you had a scheme that had 10 million of 10 million of liabilities, 5 million of assets, hence 50% funded, and a £5 million deficit, if the liabilities halved in value, in theory you'd be happy with 0 assets, 5 million of liabilities, 5 million of deficit. That turned out not to be true. That them seeing their funding position in percentage terms erode dramatically showed that was what they cared about more than their than keeping the deficit stable. So that was quite a big learning point. The other one that's allied to this is we had a couple of schemes where they had some significant illiquid assets. So, for example, in one case it was Woodland, and it was linked to the sponsoring employer through expertise rather than a direct link. And whereas before the crisis, this was a reasonable chunk of their growth assets, as both their liabilities and assets fell in value, the value of these illiquid assets became a higher and higher concentration. And in fact, it got to the point where they only had this illiquid asset plus the LDI funds in place. So it became 100% of their growth assets. So obviously that's not a great situation to be in. And the last ones that got hurt, and these are probably the ones that got hurt the worst, were the ones that were fully hedged right up until the point at which the these schemes, where they missed cash calls at the bottom, at the worst of the crisis, which meant that they were underhedged when the market turned around. So they fully participated in the downside, in the upside, and only partially participated in the downside. So they got hurt really badly. So it was a bit of a mixed bag, but overall, the average funding position of DB pension schemes did improve over this period. So again, I think the whole thing was badly misreported. Another thing that puzzles me or makes me think that some of the thinking has been a bit woolly from commentators and even regulators has been that people talk about the risk from LDI, the crisis, and what's happened, but actually there was more than one risk, and it's better to
has he fallen off? Or is he frozen again?
So he's fallen off, it looks like.
Oh, there we are. Apologies, everybody. Looks like Steve's having broadband problems maybe at the moment.
Well, we could do a reaction so far.
Well, go on then, Henry. Let's do a reaction so far. Anybody like to?
It sounds like it was a good thing, this LDI crisis, eh? I'm not sure whether I'm quite so sanguine as Steve about it, but opening up to discussion, it's not really my call.
Okay.
Steve, are you back?
Oh. Yeah, what stage did I drop out?
About 45 seconds ago, something like that. Your broadband, I don't think you've got a problem with your broadband, but you are,
okay,
yeah, struggling. Anyway, go on. Yeah.
Right. So if we're talking about winners and losers, right? I'll lose the slides because then I can. The trouble is with the slides.
Steve, you were just explaining that there was more than one risk. It wasn't just
Okay.
one simple risk.
So the three risks that, as I see it, is one is the collapse of the gilt market as a whole. So this is systemic risk to the market. The second one is that individual pooled LDI funds fall in value below zero, that they get destroyed. And the third one is the loss of hedging for pension schemes. Now, different regulators, different participants have got skin in different of those risks. So, for example, the reason the Bank of England came in and took the actions they did wasn't because they cared about pension schemes. In fact, if they cared about pension schemes, they'd have stayed away. They cared about that first risk, the collapse of the gilt market. That was what they were trying to protect, and rightly so. That is something that they should be caring about. The fact that LDI funds might have fallen below zero in value, that isn't a problem for pension fund trustees directly. It is a problem for fund managers. It is a problem for investment banks. It is a problem for FCA in its role as regulating fund managers, but it's not necessarily a problem for the trustees. The biggest problem for the trustees' perspective is the loss of hedging, that you can't make the cash calls, particularly if that's then followed by an adverse market movement, which is what we had. It's that bounce with you knocked out when we're at the bottom. But most of the action, most of the discussion has been about the other two risks, which are not really problems for pension fund trustees, in my view. Now, in the aftermath of the crisis, the actions that were taken, fund managers reduced the target level of gearing in LDI funds. So typically what we found was funds that used to have a gearing of 3 times were taken down to 2 times. Funds that had a gearing of 3.5 were taken down to 2.5. So it was quite a dramatic movement in the level of gearing that providers, and I think that was a rational move to take, in as much as the level of volatility obviously we'd underestimated how volatile the gilt market could be. So taking down the level of gearing for me was quite a sensible thing to do. The FCA which in the timing seemed to be almost simultaneously, but the FCA guidance got them to reduce the gearing anyway. But I think most of the fund managers had already reached that conclusion for themselves. The TPR also issued guidance to trustees. Most of it was reasonably sensible stuff that would have been done by the majority of trustees anyway. There are aspects of it that are related to explicitly stating. So for most of our clients, there were small adjustments needed to the statement of investment principles, not to change what was being done, but just to make it more explicit, particularly in terms of the targeted level of hedging and also the collateral calls, how they're going to be dealt with. But there's also some resilience testing for collateral movements that they've issued guidance on. Now, sort of cutting to the chase a bit, and this might go some way towards Henry's rationale for LDI is or was. The first thing is that defined benefit liabilities value is sensitive to changes in long-term interest rates. Typically, the average duration is about 20 years or so. So 1% change in gilt yields gives a 20% change in the value of the liabilities. The second observation is that the gilt yields themselves are very volatile. And the third one is that they're unpredictable. anyone who tells you that they know what's going to happen to the gilt market next is either an idiot or thinks that you're an idiot, or possibly a combination of the two. The fourth observation I've got is that this interest rate risk is unrewarded. So some of the investment risks that pension schemes take or other growth assets, we know those can go down as well as up in value, but there's good economic reason why over the long term they should go in your favour. That's not the case for interest rates or inflation expectations. They'll rise sometimes, they'll fall sometimes, but it's a fairly unbiased movement. And so to be rational, we want to remove unrewarded risks, particularly when they're so volatile, so large. So we want to fully hedge, in my view. But most pension schemes don't want to use all of their assets for hedging, and that's why you need leverage exposure to the gilt market or some proxy for that. So that was the original rationale for LDI. Now, none of those 7 observations have changed. In fact, some of them have got more extreme. So the fact that gilt markets are volatile and unpredictable is probably more extreme now than it was pre-crisis. So for me, the need for LDI hasn't gone away. It's still there. So what's the future for LDI? In my view, unless things change, there's going to be greater demand for hedging amongst DB pension schemes. The reason I think that is threefold. Well, one is the TPR's new defined benefit code, although there is some question mark over whether that'll actually be launched or not. The second one is there's been a lot of schemes where they made out like bandits because they were under hedged or not hedged at all, where they're now looking to lock in the windfalls that they got. So we saw quite a lot of activity of people taking the opportunity to lock in the gains that they've made. And the third one is there's a lot of schemes moving to buyout. Now, pension schemes can choose whether they hedge fully or not. If they go to an insurance company, I'll guarantee you that the insurance companies will fully hedge those liabilities in terms of interest rates and inflation. So the direction of travel for me is still that the demand for hedging will increase. However, I think there's probably less need for gearing. So the better funding positions that schemes have got, the fact that schemes are maturing, durations are reducing just as a function as to what's happened to interest rates, that's reduced durations, all of which mean that the amount of exposure that's needed is smaller, coupled with reduced allocations to growth assets. And there are some movements away from that in terms of the Mansion House proposals, but I think as it stands, the allocation to growth assets is going to be reducing. So more hedging needed, but more firepower to do the hedging, which might mean that there's less LDI required. And we are seeing some schemes that are fully hedging without using any LDI whatsoever. They're just using standard bond funds, long dated bond funds, to do the hedging. So just before I hand over for questions then, in terms of takeaways, for me, LDI is still sensible for most or certainly a large number of pension schemes. The second one is that some schemes are going to need a higher weighting to LDI than they previously did, just because the level of gearing in those funds is lower. They're less efficient than they used to be pre-crisis. The third thing, and this was really highlighted by the reaction when the crisis hit, is that the understanding of stakeholders of LDI probably needs improving. So trustees and sponsors, although we try and get them to the point where they can make an informed decision at the point at which they make the decision, 3, 4, 5, 6, 8 years down the line, they've forgotten what they knew about LDI. So when there was a crisis, there was a lot of hand holding and calming down needed. So we've had greater demand from our clients for additional training on LDI and what's going on there. The fourth thing is that you need to check that your hedges are accurate. Inaccurate hedges, when there's big market movements, can be quite expensive. So one of the things we found was that the frequency of checking hedges has gone up, and there's that. The fifth one is to make sure that the investment objectives that you've set are actually the objectives that you need. So the best check of that is, can your investment objectives be met, and yet you're still really unhappy with the outcome? If that's the case, then you haven't set your investment objectives properly. I'm very cautious about trustees that tell me that they want to maintain a deficit of a certain size. I think if for schemes that are close to buyout, that might be a bit more of a realistic objective. But if they're not close to buyout, then I'm very loath to let them have that objective without it being challenged quite severely. The sixth thing there is dealing with cash calls. Need to have clear, explicit rules for that. When the market's moving quickly, there just isn't time to have a discussion and decision. It's better to have those decisions made in advance, explicitly clear, so things happen automatically. We were quite fortunate in that almost all of our clients had those clear rules in place. Otherwise, I don't think they'd have coped very well with the crisis. The other thing is that in certain cases, money was needed that day by the fund manager, and what that meant was that even if you had clear rules, there wasn't time to liquidate assets from one fund manager, transfer it to the second fund manager, the LDI fund manager, in time. So having all your assets with either one fund manager or on one platform, there's an advantage in terms of dealing with cash calls there. And the seventh thing for trustees is that there's now a need to test and monitor the resilience of their LDI setup. So the thing to look at there is, if you're using pooled funds, the resilience against the pooled fund going to zero is handled by the fund manager themselves, and they're dealing with that pretty well. What we need to look at is, at what level do we run out of cash to make the collateral calls, and what's the impact on the level of hedging. Okay, I've covered the things that I wanted to cover in terms of our takeaways. I'm happy to throw that open to questions.
Yeah, thanks, Steve. That's good. Bob, you've got your hand raised. And then I think there's a few comments in the chat. But Bob, if you want to unmute and ask a question or make your point, that'd be great.
Okay, Steve, thank you for your presentation of your views on LDI. Literally, you made a couple of comments about unhedged pension funds, calling them bandits. I'd like you just to explain a bit more why you think that.
Okay, I mean, I've been a bit flippant, so apologies if that is not your thing. For me, taking risk. I mean, pension schemes in general can't afford to take zero risk, or very few can. Taking zero risks unsustainable. So you need to take risk, but you're looking at all all of the risks should be because you've got a better than evens chance of making gains from. So things like having exposure to equities because you think over the long term equities should outperform. For me, that's a sensible use of a risk budget. If you believe that there are active fund managers that can call markets or stocks, and you give some of your risk budget to fund managers to make active decisions on your behalf, for me, that's rational and sensible. I do get worried when investment consultants or trustees think they know which direction long-term interest rates are going to go. And maybe that's coloured by me being I used to manage bond funds, so I've done it for a living. As a whole, and I think a lot of laymen, and I include investment consultants in that, underestimate how difficult it is. One way of looking at it is most active bond managers don't take any meaningful duration bets. They don't bet on the overall direction of the market because they find it too difficult to call, and they spend all their time looking at these markets. So bandits, yeah, I'm happy to take that back. I think there are some cases where schemes had underhedged because their growth, their return target was so large that the amount they put into growth assets sort of crowded out what they could do. So they would hedge as much as in growth assets. For me, that's rational and sensible. But if it was just that they felt, well, yields look low, they're more likely to go up than down from here, so we won't bother hedging. I think that was ill-advised, but they got lucky with it. That's a person.
Steve, I would disagree with that because quite clearly, the year before, both the Fed and the Bank of England stated that quantitative easing was going to stop and quantitative transitioning was going to start, which meant that interest rates were going to go up, gilt yields were going to go up. That was a fact. And a large number of LDI funds didn't actually take that on board. And when things started to go a bit awry during the summer, people like Con Keating actually did blogs saying this is what's happening. So it wasn't unknown. And you talk about bandits of pension schemes being unhedged. I think that's totally and utterly wrong. And you're losing sight of the fact why are pension funds invested in the first place? It's not all about risk management. It's about actually accumulating enough assets to pay pensions as they fall due. And LDI is all about actually just managing an artificial funding deficit, which goes up and down based on gilt yields, effectively, which is what you're trying to manage, which is something different. So I just think that there's been 15 years worth of LDI contracts being foisted upon pension schemes because the TPR felt that was a way of reducing risk, when reality is actually managing something different, a different aspect of funding of pension schemes, which was artificial. That's my view anyway, but I'll keep quiet from this point.
No. There's an awful lot to unpick in that. There's about 4 or 5 things I want to say, and I'm probably going to forget at least one of them. So first point I'd make is in our industry, we don't do ourselves any favors because we use words for several different meanings. Interest rates is a great example. So when I was talking about interest rates, I was talking about long-term interest rates, the yield on 20-year gilts, for example. The Bank of England, the short-term interest rates set by the Bank of England is more predictable where that's going to go, but you don't make money off that, and that doesn't necessarily impact the 20-year gilt yield. When I was managing gilts, I mean, I saw several times when in the central bank would make movements at the short end, and the long end would go in the opposite direction.
Inverse curves, yeah.
So I do reject the fact that, see, if fund managers felt that the market if the gilt yields were definitely going to rise, they would have sold them They would have already been taken into account. The market's pretty good at taking into account what's already out there. The other thing I'd say is that, 15 years ago, all you could hear was there was a lot of noise from people saying that gilt yields are historically low. There's only one direction for gilt yields to go. They've got to rise from here, and it didn't. It fell. And the next year, well, no, now it's really got to rise. Now, every year, now, gilt yields, they'll rise and they'll fall. Now, in 2022, the scale of the movement was spectacular. But there's been the same people calling for, gilt markets are going to be, gilts are overpriced. Gilt yields have definitely got to rise. Okay, they didn't this year. They've definitely got to rise. Okay, they will do this, and you keep hearing it. Eventually, people will be right.
I think
I can say house prices will fall. If I don't give you a time scale, I will be right. It might not happen for 10 years, and so that's the point on that. The other point you make about the sort of the artificialness of the whole thing, I've got a lot of sympathy for you or with that argument. If we go back 30 years. Before the accountants started doing the mark-to-market stuff, before the minimum funding requirement, before the TPR got created, where pension schemes were genuinely long-term investors and could take that attitude. There was no intermediate valuations that were required. I mean, I know actuaries did do valuations, but they could adjust the assumptions so that it was smoothed and it wasn't such a big hurdle. And the consequences of having a deficit were nowhere near as great as they are under the current regime. You've got to question why anyone would have any exposure to bonds whatsoever. Under that environment, it probably made sense to be 100% in growth assets, equities, and so on. And that's not me being flippant, facetious. For my own DC pension pot, where I don't have intermediate targets to meet, where I can tell I'm not looking to retire for the next 20 years, I've got 100% in equities. And I'm completely comfortable with that, completely comfortable with the volatility that implies, because it doesn't matter the volatility. I want the best end result. And that was the case for pension schemes. But so I share your frustration with the regime we've got, but we have got this regime. So I think it was rational for pension schemes that if your funding position on an ongoing basis falling meant that the contributions that were required off the sponsor were unsustainable and would break the thing, then that is a valid risk for you to consider. That is a valid thing for you to look at. The other thing I'd mention on this, and is I've always found it a curious position with people that are happy that fixed interest gilts rise and fall in value as the market moves, but can't countenance fixed liabilities changing in value as markets move. For me, it seems a bit of an inconsistent way of looking at the world, in that mathematically the two are very similar. One is a set of cash flows that you owe someone else, and the other is a set of cash flows that someone else, UK government, owes you. If you're happy that one moves as interest rates move, surely the other one does as well. If you don't think either of them move, then you don't have to worry about the gilts crisis, because the gilts didn't change in value. It's just a mark-to-market thing.
Steve, gilts are fine if you hold them to maturity, because you know what you've got. If you're trying to put a value on them at any point in time, the value will change depending on circumstances of the markets, generally, people's perceptions of what value is. So we could have long discussions on that, but we won't get very far. But I'm just fundamentally saying that there was a big market change, and that was at the end of 2021, where it was clearly signalled by the Fed in the US and by the Bank of England in the UK that there was going to be a change of direction, which meant that effectively in the UK, the Bank of England were no longer going to be buying or subsidising gilts by buying them. They would be actually selling them, which actually was a signal that there would be a change of direction of interest rates, which is what actually was happening throughout the course of 2022. And halfway through 2020, by the summer of 2022, just before Truss became prime minister, before Kwasi Kwarteng did his Kazi budget, things were moving. So it was obvious that what was going on. And obviously various pension schemes had cash calls from LDI managers saying, we need to fund this. So it's a series of issues that really created, a blow up in the end of September of 2022, which was foreseeable. It was foreseen. It's undefensible, basically, what actually happened.
What you're talking about is the signalling of what's happening in the short end. And what I've said is that that's not related to long end. So, for example, when I first started as a fund manager, the Fed had just raised short-term interest rates in the US, and basically, if the US does something, the rest of the world follows suit. They'd raised the short end very aggressively, and signaled that this is the direction in which they were going. And that was the start of the great bull rally of international government bonds. So, I mean, let's face it, if you could predict what's happening to the gilt market, I'm not talking about short-term interest rates. What the Bank of England does next is reasonably predictable, and you don't make money off predicting that. If you think you can predict accurately what's going to happen in gilt markets, then we shouldn't be working for a living. Let me in on your secrets. We've got access to unlimited wealth, if you can predict that. Now, having been in it's not as easy to predict, because if it's obvious to you and everyone on this call, it's obvious to the fund managers that are managing assets.
Yeah, Steve, I would say, I don't want to get too much of an argument on this, but I agree with you. It's not possible to predict where markets are going to move from day to day. It's not possible. But when you get signals from both the Fed and the Bank of England saying that what we've been doing for the last 8 years or so, we're changing direction, we're going to move direction, it does have an impact. And that comes back to where the investment consultants advising the trustees of pension funds who were hedged or unhedged, there was a need for the investment consultants to give appropriate strategic advice to the trustees as to about what was going on and the direction of travel and what it meant for their particular pension funds. And what I've seen over the last sort of 18 months or so is that probably there's a lack of guidance from investment consultants to trustees to explain. And you've already explained, Steve, that probably with some of your clients maybe were better prepared and better protected with cash call type strategies in place to be able to move quickly, which is great. But a large number of pension funds trustees were not fully aware of what they were actually investing in, and they were making decisions effectively in the dark, or not making decisions because they weren't getting the appropriate advice at the appropriate time. And that's the problem, that when you enter into complicated investment strategies and the trustees don't fully understand what they've got, you get problems. And October 2022 was a blow up of that in a bad way. And for pension funds, and some, various people have said the TPR, the ONS studies are suggesting that somewhere between 400 billion to 600 billion of assets over the 2022 year disappeared, which could have been retained had pension investment consultants advised their trustees, now's the time to get out of the market, or it may be good to change the direction. And some trustees were advised to do that, but the majority weren't. And to think that pension schemes are in a better place now because interest rates are at 4 or 5%, and the funding levels are around 100, maybe 102% or so, is good news, and it is good news. But it could have been so much better had those pension funds that had been invested in gilts at the start of 2022 taking action to actually effectively lock in the gains that they had actually made at that point.
Okay.
And hedging is part of just smoothing the process. And Steve, I'm going to shut up now. So I'm going to sort of close myself off and let somebody else have a word. But I appreciate what you're saying, Steve.
One really important point I want to make is that you said that investment consultants should have seen this coming and advised their clients. That's something I fundamentally disagree with. For me, investment consultants shouldn't be dabbling in tactical market calls at all. The advice I give to my clients is based on understanding their needs, their objectives, their liabilities, not based on crystal ball gazing, guessing which markets are going to out or underperform. If anyone can do that, it's not investment consultants, it's fund managers. So you delegate that decision to fund managers to do. I think some of the worst advice I've seen coming from investment consultants has been when they've tried to play sort of amateur market callers. They don't have the skill set. They don't do the research and the detail that's needed. And I think it's a really dangerous thing to do.
Okay, Steve, thanks for that. Peter Cameron Brown, you've had your hand up for about an hour and a half, I think. So, Peter, do you want to make a question or a point, or?
Sorry, can you hear me now?
Yep.
We can hear you. Yep.
I've had some IT problems of my own this morning. My point is that, in fact, I think the fundamental problem with the LDI crisis is the assumption that the actuarial valuation should be the target of any hedging. Pension scheme is no different from any other business in that it's getting income in from its investments to pay out the benefits it's due to pay. Now, your existing investments are generating some income. Whether that matches on a cash flow basis, the outgoes is what you're trying to achieve. Now, when you the actuarial valuation is only an intermediary in that process, and it should not be the basis of which you make the investment decision. So your existing investments are still generating the same income, depending on when you bought them in terms of fixed interest, depending on the dividend yield in the so-called growth investments, which is the dividend is in fact the primary means of achieving growth in those investments. And I don't understand why pension schemes don't invest in distribution units rather than accumulation units. Because what you need to do is to match your cash flows in and out. And we escaped in the LDI crisis because we challenged our investment consultant who was recommending it to us, saying, hold on, we're not intending to buy out in the short term, so we have no cash flow requirements other than to pay the pensions over the longer term. What is this going to do to our income flows? And of course, the LDI at that time was there was virtually no return on cash assets. There was absolutely no income. So effectively, we're generating a zero return from a suggested significant proportion of our assets, which was going to put us in a worse position. So we held off, and of course we've done very well in terms of valuation purposes. But we're looking at the valuation now and saying, hold on, the interest rate has gone up, therefore our liability measure has gone down, but our liabilities haven't gone down. So the surplus that we're now showing, which is very large, is illusory. It's not there, and we need to look at it better in the future, because we actually have to manage the scheme on a different basis. And when I've talked to finance directors, particularly those who have long recovery plans and probably smallish schemes under professional trustees who have gone into leveraged LDI products in the years before 2022, they are absolutely shocked that it's assumed that they wanted to go to buyout on those terms, effectively, which is what it was by doing LDI, and the cash flow implications on the company of that, because they had a long deficit recovery plan, so they've got to make up those contributions, and that was actually bringing them forward that process. The company was able to give guarantees to the pension scheme, so the pension scheme wasn't at significant risk in that situation. But so in a sense, I think the fundamental principle of match hedging to actuarial valuations is the primary problem. and I think trustees need to be challenged on that. I think that's what we're doing. So those are my views.
I mean, as I said before,
Thanks,
I sort of share sympathy with the idea that in an ideal world we wouldn't have to do that. But I don't think we live in an ideal world. I think if you look at pension schemes that have hit the headlines, and like I say, if you hit the headlines as a pension scheme, that's because something's gone wrong. I'm not aware of any that had trouble with cash flows to meet benefits in the short term. The reason that they hit the headlines is because their funding position on one measure or another has deteriorated to a point which it's created a problem. Now, that's not always the actuarial, the ongoing funding level that's deteriorated. It might be because the company's gone under and you need to try and buy out whatever you can buy out with what's remaining. But that is still a measure of the liabilities that you're comparing it to. But in the real world, I mean, if for a lot of our clients, it was the regime under the TPR which was guiding what was going on with the scheme and the main concerns of the trustees, that recovery plans were difficult for the sponsors to meet. And certainly they didn't want their funding position on an ongoing basis to deteriorate further over a 3-year cycle, which would imply that they'd have to pay even higher contributions. You know, so that was the thing that from a practical perspective that constituted a real and present danger for the trustees.
Okay, Steve, thanks. Jim, you've had your hand up for a while. Do you want to ask a question or make a point, or argue with Steve, or just debate with Steve, maybe?
Maybe all three, Steve. But I really liked Matt Levine's newsletter on it when it came out, sort of at that time, and he did make the point quite jokingly, but that pension funds should really be immune to market movements. It's a very long-term source. And through the magic of modern finance, we'd taken these very long-term funds and made them blow up due to market movements. But on a sort of serious point, coming from the public sector, from one of the few open cash-based investing schemes, LDI was never very popular with LGPS. And when this happened, a lot of people looked around and said, well, actually, that was a good thing that we didn't. And as sort of Bob and Peter were saying, now we look at our liabilities, which are valued based on gilts, and we go, well, our assets haven't gone up, but our liabilities have gone down. So technically, we seem in a much better position. But actually, we expect over the longer term that will come out. We're still going to have to pay those pensions out over time, but we don't have to worry about paying out that cash now. So why would a scheme like the LGPS want to invest in LDI when it gives us that risk for not really a whole lot of benefit?
Yeah, I mean, it comes down to the regime you're under, doesn't it? I mean, it's I don't think trustees and investment consultants have been acting irrationally to use LDI. I think it's rational given the regime that they're facing. Like many people here, I'm pretty frustrated about the way that DB pension schemes have basically been regulated out of existence. It's all done well-intentioned. Every step you could see why they were doing it, but there was a lot of unintended consequences that came out. Starting with the minimum funding requirement. I mean, that was a comedy of errors, really. The accountants getting in on it with FRS 17 and so on, and then the TPR, which had a shorter and shorter time horizon that they were looking at. I mean, the latest code or planned code, where schemes with duration of less than 12 years are deemed mature and really have got their hands tied in terms of how much risk they can take and how they can value their liabilities. But what that also means is that if you're 2 or 3 years away from that, can you really afford to take much investment risk, knowing that in a few years' time, you're going to be under a regime that's going to be very penal, very harsh. So I might not be as far away from you guys in terms of my thinking, but it's the fix is not to change what pension funds are doing, what trustees are doing and their advisors. It's to change the regime that they fall under. Unfortunately, I think things are going to get worse rather than better in that regard. Regulators love to regulate, government like to do things, and it can't be helped where the average tenure of the pensions ministers has been not much longer than 1 year. I mean, the last minister that we had, she lasted, what was it, a year and a couple of weeks. How you hope to get a grasp of what pension schemes are all about. Our most junior guys on our team have been in the industry for longer than that and have got better for qualifications for actually understanding it. But I wouldn't trust them to dictate what's going on in the pensions world. So I think that's the area that needs addressing more than anything else.
Okay, cheers, Steve. JQ, you have an opinion, which is unusual.
Yeah, thank you, Stephen. Thank you both, Steves, actually. Look, we've got to recognise that most schemes now are close to accrual and new entrants. Therefore, the mark to model approach, which may have been fine 25 years ago with open schemes, you can't have a mark to model approach when the ultimate mark to market is a buyout for many schemes. So you have to phase towards a mark to market, whether we like it or not. And secondly, I think the hedging point you make, Steve, is interesting. I again question whether we're going to see more matching than hedging, and in terms of schemes investing more like insurers than investing using hedging techniques into the future, because their end game is a buyout for most of them, whether we like it or not. It has to be that, because by definition, when you're close to the end of the crawl, that is the only answer at some point.
So what's the distinction that you've got between matching and hedging?
So you would use, instead of using leverage gilts, you'd use a basket of bonds and using the matching adjustment tools and techniques that exist in the insurance regime. You'd get better pickup, better yield. So less need for leverage, but it's a match rather than a hedge.
Okay. I mean, a lot of schemes are going in that direction anyway. And, for me, hedging is when you try and take out the interest rate risk. If you don't have enough assets to do that, then it implies you need some leverage in there. If you've got enough assets that you're prepared to devote to bonds and similar instruments, you don't need leverage. You don't need LDI in order to fully hedge. So I think there's certainly a drift in that direction anyway.
And most schemes, or many schemes now, given what's happened, would be in a place where they could adopt that rather than LDI.
Yeah, we're certainly seeing it far more often than we used to, and it's also helped by durations having fallen. That helps having a bond-only type of solution.
And that's going to have some impact on the great correction of out of gilts into bonds as schemes move from the current status to buyout. It's going to be an interesting dynamic in terms of supply and demand on the non-gilt market as well.
Yeah, I mean, you find when there are instruments that are close substitutes, and don't forget the investment banks will also be, if they're selling something, they'll hedge it using something similar. The demand for interest rate bearing instruments, put it that way, whether it's corporate bonds, whether it's gilts, whether it's swaps, whether it's some private investments, I think that's going to increase rather than decrease from here.
Okay, thanks, Steve. Henry, you got your hand up.
I'm asking a question on behalf of Con Keating, who unfortunately can't be here. He's travelling, but he picks up on the fact that there's quite a lot of confusion about the TPR's position, not least because TPR didn't respond to the LDI paper produced by the Work and Pensions Committee at the end of last year, when they said they would. And I wonder just where TPR's head is on this. What's your view, both of why they didn't respond to the WPC request for a response, and why we haven't got a DB funding code. And finally, you know, the very contradictory signals that seem to be coming out of TPR about ongoing funding considerations.
Okay, I can't answer as to why they didn't provide a response. You need to ask them for why they didn't. You'd have thought that they would have taken some time to do that. I think the TPR has got massive conflicts of interest. When you look at its remit, it's too much to be done by a single organisation, in my view. So I can't remember exact way it's phrased, but you know, they're protecting the PPF. They're protecting members, the security of members' benefits and so on, and the pension scheme environment. They also had added to it, and I can't remember how it was phrased, but something about sustainable economic growth of the sponsors. And when you add all of those things in, it doesn't make much sense. And I think allied to that, when you look at the LDI crisis, I think there's people have muddled up the various risks. So the politicians, the bank, the Treasury, and probably the FCA were more concerned about systemic risk and what's going on in that market, whereas the TPR, if they're looking after, you know, and just focusing on the DB aspect of it, those schemes, it should be about the more the pension schemes that wanted to be fully hedged but weren't because they missed cash calls, that type of risk, because that was the biggest risk to their under their horizon, their remit, in my view. Yeah, I don't know if that.
Okay, so I mean, basically, you don't know, we don't, none of us know what TPR's position is at the moment because it isn't published. Yeah.
Yeah.
Would that be a fair estimation?
Yeah, I think that's fair. I mean, I'm not going to try and guess what they would have said, but I mean, some of it has been a bit muddled. And I think it's because they haven't really focused on what it is they care about, what it is they don't care about. But it's certainly not helped by the guidance they've had. I mean, Henry, you sent me through something this morning, which was it'd come from Laura Trott, and so while she was still the pensions minister to the government, and there was about 9 recommendations, but for me, again, it shows really muddled thinking. So there was so many inconsistencies within one document. So, for example, they talked about the crisis, the 400 billion of loss to pension schemes, the fact that some pension schemes' funding positions had deteriorated because of the gilts crisis, both of which are true. And then right underneath that, they had a chart which showed that the average pension scheme surplus had increased over that period, which seemed an odd juxtaposition. They talk about the systemic risk and that too many schemes were doing the same thing at the same time, which essentially is what caused the death spiral in the market. It was that too much was invested in the same way. But some of their recommendations are to consolidate smaller schemes. Well, that's going to make more assets work in the same way. They were looking at bringing investment consultants under FCA regulation, which is probably going to lead to more similar outcomes for more schemes. So a lot of what they were saying was contradicting what they'd had earlier in that. And I think that is true of an awful lot of stuff that comes out of the government and the regulators on these issues. And for me, it's because they're using non-experts to come up with their proposals.
Really interesting view. Thank you very much for that, Steve.
Okay, I'm conscious of time. Chris McMullen, you put a big comment in the chat. Did you want to just quickly summarise your comment, Chris, as the last question?
Hi, Steve. Sure. As I see it, and I'm not a pensions expert. I'm certainly, my background is more in the banking side. What I saw from the outside happening is that funds were being required, or as the group calls it, cash collateral, put up the cash for collateral on the collateral calls. And one of the challenges that happen then in a liquid market, when you've got investments that are leveraged, inevitably those calls are going to be quite substantial and happen very quickly. And when they happened, a lot of the funds were forced to sell assets in a liquid market, taking huge hits or not being able to sell them at all. And the challenge came in is this word we keep using on the call today is, the cash collateral, the cash calls. Any insurance company or bank would never sign up to something that was as restrictive as what I've seen being the LDI's CSA agreements. The very one-side negotiation from a number of parties providing the LDIs that are incredibly strong parties with very, very good legal teams. If I was in a bank, it would take me probably a year to negotiate most CSAs, collateral agreements. I don't feel that that's happened with there. And I think the financial advisory, investment advisory teams probably fell short of advising the trustees of what the exposure was on those agreements. And perhaps most of them should have negotiated them a lot harder, such that they weren't forced to sell assets in a illiquid market, but post assets, albeit with a lower value, but not be a forced seller. And that forced selling is what caused the big problem for the Bank of England.
Okay, having been on the other side, I mean, my background, I was a fund manager for a couple of insurance companies and was involved with derivatives. So we used to, for our own books, we used to have individually tailored, negotiated contracts. And they were incredibly expensive to do, and certainly wouldn't be suitable for schemes. I mean, when I first came this side of the fence 25 years ago, the idea that a scheme with less than 200 million would have any LDI arrangement seemed cloud cuckoo land, just because of the cost of doing it. And it was only because these things got standardized and brought into pooled funds that it became available. With a lot of the contracts in the early days, there was no need to pass collateral back to the investment bank. It was a one-way agreement, which is unusual because they viewed the pension assets. They had transparency to where the assets were. The investment bank wasn't concerned about the credit risk from the pension scheme, but there was collateral posted by the investment bank if the market had gone the other way. That changed probably about 15 years ago or so, where it became the collateral would go both ways. And to be fair, I mean, I think the investment banks were probably very glad that they had that in place, because with the movements that were seen, some of these pooled LDI funds would have gone under if collateral hadn't been posted. So I don't think that's a problem. I think that has been done in a sensible way. And I think the pension.
But Steve, by its nature, if you're going into a pooled world, you're signing up to a standardized agreement that's been negotiated and created by that counterparty, and you are the risk taker. And that's what happened in this case, is the funds became essentially covering the risks of the LDI fund managers, who were getting more and more leveraged and therefore taking more and more risk. And I'm not sure the trustees understood that. And I don't know where the investment advisors were in explaining that risk to them.
No, are you talking about the risk that the fund goes below zero?
I'm talking about the requirement for posting collateral. So to the extent that there's a requirement to post collateral, what form does that collateral take?
Okay, so there's a few things. It's not a requirement to post collateral. If you want to maintain your hedge, you need to post collateral.
Correct.
You don't have to post collateral. So I always find it a bit curious that people say, well, you shouldn't use leveraged LDI funds because there is a risk that you might not meet your cash calls and you might be left under-hedged. So basically what he's saying is you should be under-hedged, because if you use pooled LDI funds, there's a risk that you might be under-hedged. For me, that doesn't quite add up. You're better off hedging in all the circumstances you can if you want to get rid of that risk, rather than not doing it, because there's a danger that you at some stage that hedge might be taken apart in part. So if you want to maintain your hedge, you have to post collateral. Now, if the funds had gone, you say that the fund managers were taking more and more risk. Don't forget, these are funds designed to remove a risk that the pension scheme's already got. The quantum of risk that's been removed hasn't changed. All that's happened is it's a smaller and smaller pot of assets that's doing all that work. They've become more concentrated, but the quantum of risk reduction
leverage is what I'm talking about. Yeah.
Yeah, but leverage in itself.
So leverage means when things go the wrong way, they go the wrong way in multiples rather than directly correlated. So you end up with a situation where suddenly, as we saw, there was a large amount of call for collateral, and the funds didn't have the eligible assets available to them at the time to be able to do that, forcing them to sell, or as you say, get off the hedge. In which case, what are the consequences of that? I'm not saying necessarily that. I just feel that the advisory community seems to have fallen short of explaining that to trustees, and trustees probably not understanding exactly what their exposure was in a scenario that we saw happen. Would you agree with that?
No, I wouldn't, but you wouldn't expect me to, I guess. I mean, for me, it's, again, if you look at just the assets or just the liabilities in isolation, you don't get the whole picture. So the way I'd look at it is that it's all about how much interest rate risk do you want to take. And again, I'm not talking about short-term interest rates. How much exposure to, for example, the 20-year gilt yield do you want to have? The net position. You've got a position in terms of 20-year gilts from your liabilities. If you want to get rid of that risk, you can buy an instrument that gives you an equal and opposite movement as 20-year gilts change. Now, just because there's more leverage doesn't make it more risky. It just means that it's more capital efficient. You're using less of your assets to do the same amount of heavy lifting. That's not a problem for you. It's a problem for the fund managers, because as it becomes more and more leveraged, there's a greater and greater risk that it actually goes through zero and goes out the other side. That would be great news for the pension scheme. Bad news for the fund manager, because actually, if it goes below zero, it's the fund manager that carries the can on these pension funds. So I mean, if your liabilities keep falling, and you reach zero in your LDI funds, instead of the assets and liabilities moving completely in sync, you start making a surplus, because they would, the assets, once they get to zero, don't go any further. From your perspective, the liabilities keep falling.
I think we're talking two different elements in here. One, I understand what you're saying there. I think the challenge is what really happened in the pension funds. They were forced sellers of assets to meet those collateral requirements, weren't they?
They were forced sellers of growth assets, yeah.
Which had values of, those growth assets that fell through the floor in valuation. We were talking 50% of their face value in some cases. And that was the challenge we were seeing at the time, when everyone's running around, and even months afterwards, people running around trying to find people who buy these assets where the value had fallen through the floor, because they needed to get their hands on eligible assets and convert them into gilts or other assets that would be eligible collateral. That was a massive challenge, and that to me is the flaw lies in the fact that the CSAs are very one-sided. And perhaps those smaller funds that don't have the ability to spend the money, the proper legal work on them, shouldn't be in there in the first place. because it's a risk they're taking on that either they don't understand or they don't have the ability to properly negotiate.
Okay, I'm surprised that you say that there was a problem in the growth asset market, because that's where most of the cash calls came from. In most cases, it's growth assets, equities predominantly.
Well, it's essentially what the illiquid assets that were in there, and that changes from time to time in different market conditions. But there was a large amount of illiquid assets that were in the funds that they weren't able to cash out at a reasonable price.
Is that your funds or
no? It's just observation.
Okay, certainly
talking to some of the advisors on this topic, they've come to us a lot saying, "Can you please help us liquidate this book?" And not just us; they went to every bank, they went everywhere, trying to find people to buy these assets at a price that wasn't going to completely be, 50 cents on the dollar, 50 pounds on the pound. No one was going to sell at those, but that's where the bid was.
Okay, so that's a problem with illiquid assets. I mean,
yeah, but the problem you've got is at that time when that crisis is going on, that's when they needed it. That's when they needed to convert them into eligible assets, and there was no way they could do it.
They didn't need to, did they? They could have just missed the cash call.
They could have. They could have.
So
did they? No.
Yeah, okay. So what you're saying is that the biggest problem with the pooled LDI funds or the LDI arrangements was that there might be circumstances when they might not be able to have the full coverage. I don't know if that makes sense. I
understand what you're saying. Yeah.
Okay.
Do you spend £100 to take away a risk that you might have to spend £100? I don't know if that's a good analogy or not.
Did the funds actually understand that was a risk they had?
They're probably less aware of it. I mean, what we found, a lot of the call. I mean, we were incredibly busy straight after what happened. The main reason for that is we focus on small schemes. So a lot of our clients we see once every 3 years or so. Whereas when this happened, every single one of our clients wanted to see us once, twice, 3 times. So we had some quite long days, including a 36-hour day that I did. But in many cases, it was more a case of reassuring them, reminding them of what they're invested in. And again, the thing with the understanding, they understood enough to make the decision when they got into it, but over the years they had forgotten, so they needed reminding what was going on. The headlines they were seeing in the press weren't helpful. Are we losing everything? We're getting these cash calls, we see the values disappearing. And it was a case of reminding, well, actually, if you look at your funding position, it's broadly unchanged, or in some cases it's slightly improved. And the maths behind it, I don't know if Stephen would kill me, but basically if it's all working as it should do, the allocation to growth assets doesn't change in percentage terms, it just reduces in absolute terms, just because if your liabilities have fallen by 50% in value, you end up with 50% less in LDI, 50% less in growth, but you've still got the same split between them.
And Steve, I agree with all that. I think as long as you can get through that period of crisis, then that's fine.
Okay, Steve, you and Chris need to have a lunch or something, or a private debate, because this is going on.
Yeah, I'm very happy to do that.
Yeah. Now I'm conscious of the time. We've overrun, definitely, and so I'm definitely going to say thank you to you, Steve, for putting your head above the parapet, talking about LDI. And there's a lot of pain gone on, I guess, in the past, and some are pro LDI and some obviously are not pro LDI. So that's the beauty of the market we live in. So, but really appreciate your time and your input and your presentation, and I hope everybody else did. Appreciate what Steve said today, and there's probably a lot more we could say about it, and maybe there should be a sort of maybe a post LDI round 2 later in the year, I guess, but that could go on for big long session. And I know we've got various people. Eugene had some comments to be made, and Nicola had some comments to be made. So we sort of ran out of time. But really appreciate your input. Absolutely brilliant. Thanks, Steve. And next week we've got Baroness Ros Altman. So in conversation. So if you want to sort of get into the sort of political debate, then come and talk to Baroness Altman, see what the government are doing or not doing, according to Steve Barker. Today's video will be on the Pension Playpen website this afternoon. And as usual, we want to pray for peace in the East and peace in the Middle East. So really appreciate everybody's time today. Sorry we've overrun a little bit, but there's some big issues going on and some big debates. So really appreciate everybody's time today and input. So cheers, Steve, and thanks for that. And see you later in the week, I think. So all right,
Thanks, guys.
cheers. All right, cheers. Take care. Thanks a lot. Bye.